Let's bring on board now Vikas Halan, Senior Vice President, Corporate Finance Group at Moody's, to talk a bit about the macros, especially what happened with respect to the crude oil prices. Vikas, hi, morning and welcome on board. Just, want to understand, what is your reading of the present supply situation? Is that likely to tighten going forward?
On the supply side, clearly one thing to look out for is the Venezuelan production, which is what has propped up the prices in the recent weeks. There has been decline in production from Venezuela because of some of the infrastructure bottlenecks and power interruptions and so forth. There is, a political crisis in Venezuela for a long time, but this is resulting in production cuts in there. The other side of the equation is the American shale production, where you are seeing production touching close to 12 million barrels per day in February, and there is going to be, over the medium term, 6 to 9 months, we expect that to continue to increase, with the US supply bottlenecks being sort of ironed out with infrastructure development, pipeline construction. So that's going to happen in second half of 2019, which is going to add additional bit of supply.
Vikas, what's your view on crude prices given your expectations of higher demand?
We continue to expect 50 to 70, as I said, and more specifically, if you want to have an average for the year, it's about 65 that we use. And the crude oil prices currently on Brent is about 69. But if you look at the average year to date, it's about 63, 64. So we are focused more on the average. And if we take 65 and the current average is 63, we expect a little bit of upturn in the oil prices. Not significantly higher from where we are, possibly staying at these levels. So, as a rating agency, we tend to be more conservative when taking views on prices, and therefore, our view is we need the ratings to be comfortable at the current prices, or maybe even lower prices. So we are more focused on the downside from here, and the downside that I see on the oil prices could come from another round of waivers on Iran, or possibly a no deal or less compliance of OPEC production cuts, or return of the Venezuelan production, and so forth. There could be further downside from a surprise no deal between US and China, which could have a negative impact on the demand. So these are the downside risks we are more focused on, rather than taking a view on the prices as such.
Trump continues to ask for greater production cut by OPEC in order to curb prices. Does it seem likely that OPEC would comply?
OPEC would not like to have prices at a very high level. I don't think their target is to increase prices. If they're looking to balance the market, I think the impact on the prices is not going to be very significant. The price of $70 crude oil, I think, is already sufficiently stimulative for production in North American shale. So they would not want these prices to be significantly higher than where it is today. If prices go higher than that, the $70 or Brent, we might actually see a less than optimum market balance. I don't think that is what OPEC has communicated. So I would not say that there would be a price increase because of OPEC production cuts. There could be price increase in oil because of factors that are outside of OPEC's control, including any geopolitical events.
Right then, Vikas, thank you for joining us this morning, giving us a view on the crude prices. Currently, the crude prices are at 2018 highs.